Good morning, this is Jason Carter from the floor of the CME on this Friday, January 22nd, post-Barrio terrorism on Wall Street speech. Lots of stuff to talk about today. Even though we don't have a very large range in the S&Ps, there's a general feeling here that the dynamic is changing. We saw the S&Ps come down and take out yesterday's lows, trade down to the 01 area. We were looking at support between 1101 to 1104, and we've seen to bounce back up to about 1109. We've definitely seen some increased volume. We're about 1.7 million shares in the E-minis. Option volume today is about 33,000 contracts, which has been up the last 5 days, averaging I think between like 40 to 50,000. On the technical side, I've been paying a lot of attention to Goldman Sachs. Goldman Sachs yesterday traded, we traded right below the support level, about 157, and also below the 200-day moving average, which looks like to me that we could be testing 135 here if this thing really wants to roll over. Another important note to that is that if you look at, the Dubai sell-off in the S&P would come in right around 1061.30, which means that if we get down to, those levels in Goldman, that would put the S&P right around 1050 to 1060 level. The dynamic is changing here. The trade is to buy this thing on Friday. With Mutual Fund Monday that Danny always talks about, it's easy that we could probably see this thing back up to 1119, 1125. Coming into Monday. If that's the case, my personal opinion is you need to be selling 1119 to 1125. Bottom line. As you know, from time to time we like to bring in some special guest presenters, and today we have an extra special one. We have Jessica Hoversen from MF Global, who's a fixed income analyst over there, and she's going to get on and talk a little bit about some of the macro things she's seeing in the credit markets.
This is Jessica Hoversen. I'm with MF Global. I cover the bond market and the currency market, and I'm here to provide a little bit of macro color on what's going on in the capital markets. So I think the largest macro theme right now is definitely the political dynamic, and I think that the events of this week really do emphasize and exhibit why politics are so exceptionally important to the markets. So three main events happened this week. First off, we had the confirmation, we had Senator Scott Brown take over the vacated seat by the late Ted Kennedy. Why is that very important? Because it really is the manifestation of the populist view. It shows that people are very tired of the center to left politics that have been happening in Washington, and the fact that the Republicans captured a Senate seat in the bluest of the blue states makes other Democratic senators exceptionally nervous, because they know that the populism is leaning to the right, and so they're going to have to do the same thing. How did the markets react? It was bullish for the dollar. It was bullish for the S&Ps. People like the fact that you are going to see some more center politics happening out of Washington. Secondly, you had the delaying of the confirmation of Bernanke's testimony. Why is that a big deal? It's a massive deal because Bernanke basically wrote the book on the Great Depression. The markets like Bernanke. They don't want to change captains in the middle of the storm. While the credit spreads have normalized, while the financial markets are back in shape, while we are seeing repair in the economy, we know that right now we simply can't take Bernanke out of the mix. And if we do see a further delaying of his testimony and his removal out of office, out of the chairmanship of the Federal Reserve, we know that the capital markets will likely respond negatively. What's it going to do with the dollar? Probably bearish the dollar. I don't think people want to see Bernanke taken out of office. Thirdly, obviously the proposed plan by President Barack Obama to basically prohibit banks from engaging in proprietary trading. Why is that negative for the markets? Well, first off, it reduces liquidity in the markets. These banks play a very important role in providing liquidity. Secondly, the markets have to think how it's going to impact fixed income. It's negative for the mortgage markets, for corporate debt, even for the treasuries. I think it's very interesting that Barack Obama chose to make this announcement in front of a 2-, 5-, and 7-year auction next week. It'll be very interesting to see how the markets react, given that how the markets react in front of that heavy treasury supply. The auctions may not go over as well as they have, given the fact that we have this new proposal. Thirdly, what is it going to do for the dollar? I think that it's got two ways on the dollar. First off, it's bullish the dollar because for a very long time the dollar has been a funding currency. People have been basically using dollars to fund more aggressive emerging market currency trades. So if banks are forced to delever their positions, you're going to see a mechanical bid in the dollar. What's going to happen? Well, how is it bearish the dollar? Because I do think that the elimination of the bank's ability to engage in proprietary trading makes people nervous about U.S. assets. How is that? How is that going to just impact the entirety of the market? I think it makes people it reduces confidence, and additionally, I think it just sort of exhibits the fact that Washington is getting way too involved in this situation that they really are just very, not ignorant of, but they just don't understand. This proposal makes the market recognize that Washington is just ignorant of the current financial system. This is not the 1960s. This is not, we're in basically entirely new paradigm in terms of lending and credit markets. Financial disintermediation really opened the doors for the integration of global capital and the elimination of, I think, the elimination of this ability of banks to engage actively in the market is overall negative. How's that going to impact the trade next week? Well, I think obviously that if Bernanke's testimony, again, as I mentioned earlier, is delayed, I think the overall impact is negative. We're also going to have to focus on those treasury auctions. Supply has been a big negative for the bond market, but given the economic landscape, treasuries have been able to remain bid. And thirdly, we're going to watch the economic data. We got a lot of housing starts, existing home sales. We'll have new home sales. I think the home price, the home is the biggest asset on the consumer balance sheet. And if we can't consistently see improvements in home sales on top of improvements in home prices, we know that the consumer is still quite beleaguered, and it's going to take them a long time to recover. Oh, go Marquette. Yeah, go Marquette. They're going to beat Syracuse. We're not ranked, but we're ranked right here. That's where it really matters.